Hey, it's Jim, and this is FRM Part 1, topic on financial markets and products, and the chapter on central clearing. The good news for you guys is that this chapter follows the chapter on exchanges and OTC clearing. While that previous chapter was a focus on the organized exchanges, this chapter is a focus in over-the-counter clearing. And you'll see that as we go through these learning objectives, some of these look almost exactly like what we had in that previous chapter. Notice we want to worry about the role. There's bilateral and centralized clearing, advantages and disadvantages. We need to worry about margins. We need to worry about netting. We need to worry about collateral. So a lot of the stuff that we talked about in the previous chapter is relevant here. But of course, the focus now is going to be on in the over-the-counter market. There are some trades that are bilaterally cleared, but the majority of them are still centrally cleared. Now, let me just remind you of something that, back in the old days, the over-the-counter market was characterized by, just total customization. But of course, over time, that has evolved. So even in the over-the-counter market, there's lots and lots of standardization, which makes it more sense for some kind of a central organization to come in and keep track of winners and losers. So let's go ahead and look at this first learning objective, one that you know from that previous slide deck. So you know what a central counterparty is. You know that when two parties trade, they sign a legal and binding contract, like a forward contract or a swap contract or even an option contract. That's an agreement to do something in the future between two parties. Now, when the central counterparty is created and arrives at the scene, from a legal standpoint, that CCP has to say something like, all right, you two people are trading, but why don't we create two separate legal and binding contracts? So the CCP will have one contract with a long position, another contract with the short position. So that those two contracts replace the one contract. So instead of having these two people worrying about each other, now the central counterparty steps in and takes care of all that stuff. And when I say all that stuff, well, that's what we're going to do over the next 30 or so slides. But lots of these slides are going to be similar to what we did in that previous chapter. Look at that third diamond point there. It eliminates counterparty exposure. So if you and I are trading individually, I don't have to worry about tracking you down. You don't have to worry about tracking me down. We know where the CCP is. It's somewhere. Like with, what are some of these clearing counterparties called? There's the swap clear, there's the ice clear, that's part of the intercontinental exchange, and then there are probably a handful of other ones out there. But the point is that we know where these organizations are. We can track them down. Now look over on the right, there's this default fund. So what does the CCP do? The CCP says, you know what, we have our own capital, but every time two organizations or two individuals trade, we're going to say, you know what, if you guys are trading something for $100, we want you to pay us, each of us, you pay us a dime. And we're going to put that into a default fund so that if you default or the other party defaults, we've got some kind of a buffer. So that default fund has, kind of two things to it. It has member contributions, which are all the individual traders that are out there. And then this NG clearing contribution, which is all part of the CCP and its equity and its goodwill and all that kind of good stuff. So once again, we're going to have an initial margin, and then each party, short and long position, puts in an initial margin. And I tell my students this all the time. In fact, just the other day in the investments class, we were talking about futures contracts, and we did a corn futures contract for 20,000 bushels. And I said, hey, you know what? Both parties put this amount in, and by the way, you can use treasuries if you want to. We'll talk about that in just a little bit. You could actually use almost anything you want as collateral, but then you have to worry about liquidity. But I said, hey, that's your money. That's the long and the short positions money. So it's almost like these transactions are free. I don't like using quotes, but I'm going to do that. You don't really have to pay for them unless of course it's an option. So that initial margin acts as a buffer, and that's the first buffer. And then of course one party is going to win and one party is going to lose. This is a zero-sum game, and when the losing party, when their balance, so to speak, their margin gets below a certain amount, they're going to get a margin call. So they've got to deposit something that's called a variation margin. And in a perfect world, that initial margin for both long and short positions would be sufficient to cover all the gains and losses. Now that would work, if prices went like this. Can you see my hands? They're squiggling just a little bit. But what do we know? We know oil prices go way up and they go way down. So that initial margin is not going to be sufficient to be a buffer to support all of the losses on one side or the other. So you need collateral, and you need this default fund in there. So what happens then is that if one party defaults, then that means that they can't put in the variation margin, and then we have to go somewhere else. So we'll go to the default fund, maybe we'll go to some equity, maybe we'll go some collateral, maybe we'll do something else. But sooner or later, we need to support those losses. And of course, and the chapter talks about this systemic risk, meaning simply that, if I'm a huge financial institution and I default, well, I've got positions all over the place. Even though we're centrally clearing, well, my default may impact others' balance sheets and profitability. And so we worry about this systemic risk. We called it contagion back when I was in graduate school. Now, I think you guys know from watching my recordings over the years, and especially since I went through the Part 1 and took the Part 1 exam a little bit ago, one of the really cool things that I like about GARP and its testing is that it loves to test on historical events. Now, these two are talked about here in the chapter just a little bit, but I think it's always important to know your history, and that history will help you answer some of those questions. Because if GARP is telling you about Lehman Brothers, and by the way, I'm guessing that many of you lived through that, unlike I did, just being a college professor in 2008. But you guys probably lived through it, so you know the consequences of when you have this active member with thousands of outstanding positions, and some of them are winners, but lots of them are losers. Especially when we bet in the mortgage-backed security market, and all these residential mortgages are failing and failing and failing. Well, the cool thing is that look at under the yellow arrow point there. Yeah, those clearinghouses and the exchanges, they liquidated this all, and there were no losses imposed on the non-defaulting members. So this was really it was an acceptable outcome. And so GARP is likely to ask you questions, maybe not specifically about Lehman, but just some kind of hypothetical scenario. All right, here's a learning objective on the difference between you and I trading versus all of us trading. And so what we need is for some organization, this CCP, to keep track of all of this stuff. The big advantage is that it pretty much, I want to say, virtually eliminates that counterparty exposure, because we have things like margins, and we have things like collateral, and we have things like a default fund. But if you look at those 4 bullet points going down the bottom there, this is how we're reducing systemic risk. These are 4 potentially really, really good exam answers. Bilateral clearing, this puts a lot of pressure on you. So if you and I are trading, and let's suppose we're trading, 100 100 futures contracts on gold, and you don't know me and I don't know you, and we're going to try to trade, I'm going to say, boy, I need to do lots and lots of research. Now, of course, in the bilateral market, it's probably not 2 individuals like you and me, but 2 financial institutions. And if these are 2 powerful financial institutions like, Gibraltar Insurance and rock financial company, then it's probably okay. It's still not as the value of risk reduction as that occurs in central clearing. But if I'm Jim's weak and straw bank and I want to enter a trade with you, well, then you need to do lots and lots of research with me. So look at that first diamond point. Assess, manage, collateralize, all that kind of good stuff. We probably don't have multilateral netting, so it's just going to be between you and me. What did I say? Jim's straw bank. That can't be a good thing. All right, here's some good exam questions, right? Drawbacks, fragmented risk. You're going to ask me to put up, well, maybe I'll just put up some straw. Maybe I'll say, you know what, all I have is straw. I'll put that up as collateral. And you'll probably shake your head and say, gosh, Jim, how the heck are you even in business? Lower transparency, of course. Yeah, interconnected exposures, which, this is so important. Look at that third one there, lower transparencies, which results in all of these exposures that the market may know about, but they're likely to not know about it, which means that systemic risk, it creeps up on you. I do that to my granddaughter, when I'm playing around with her. So it's the same thing. You don't know about it, and all of a sudden, you pull the blanket over and you're thinking, oh my gosh, look at all of the bugs underneath that rock. So centralized clearing, that takes care of all that stuff. Here's a good slide to take a picture of. Lots and lots of good exam questions on here. But again, remember there's 20 chapters inside of this book 3, and you're only getting 30 questions out of this. So this is potentially one question. But now let's link this with the previous chapter, and boy, the GARP can come up with one really, really good question that combines these two chapters. Let's go ahead and take another picture here. Advantages and disadvantages. We talked about these different kinds of risks back in the previous chapter. A couple of things to point out. That first one up there, we said that reduces counterparty credit risk. We do like multilateral netting, but I want to call your attention to that fourth one down there, the default management framework. So this is really just a scenario under which the CCP is saying, you know what, we know that some people out there are going to fail, not through any fault of their own, but just because prices go way up and prices go way down. But it's our job, it's the CCP's job to make sure that when individual organizations or financial institutions fail, that we're there so that the system doesn't fail. There's that systemic risk. Over on the disadvantage side, of course, when you have the CCP writing and creating contracts with each individual institution and organization out there, you have this single point of failure. So if a CCP fails, then this is disastrous. So that's called concentration risk. Margins, initial margins and variation margins, they go a long way to mitigating liquidity risk. But the problem, of course, is that for the CCP, they rely on models. And the chapter has a really interesting sentence in there that reads something like this, and I'm paraphrasing, that the initial margins are determined based on historical prices or something like that. So this is a model, and it sounds okay. But the question then becomes, if the price of gold is doing this, of course, we're in the mid-2020s here, and the price of gold is just going up and up and up, all because of inflation. Oh my gosh, the government in the United States is spending a lot of money. Are we surprised that there's lots and lots of inflation out there? Anyway, so what happens if all of a sudden the U.S. Fed says, you know what, we're not satisfied with 2 or 3% inflation rate. We want 0% inflation rate, which might have been suggested by some of those great economists out there. Maybe Milton Friedman thought about that. Maybe Thomas Sowell thought about that. Anyway, so if we're basing a model on 2 or 3% inflation, and then all of a sudden we've got a Fed or a government regulatory body suggesting something different, well, then that model is going to fail. So this is a great question. If I'm GARP, I'm asking this question because model risk is a common risk throughout lots and lots of these topics that we talk about. Now, what was I saying just a little bit ago that GARP loves to talk about history, and so of course there's going to be a discussion in here about 2008 and the financial crisis. And the great question is, what did that reveal? It revealed the problems with bilateralization. Is that a word? Excessive counterparty, lack of transparency, interconnected. Now we use the term interlinked. So this is super important in terms of relating an historical event with, some of these risks that are out there in likely exam questions. All right, so what happened? We had all these really, really important people from 20 governments out there, and they came up with this. So in the over-the-counter market, when you have a standardized derivative, that it should be centrally cleared. And I think, I don't know when this chapter was written, but I think in the mid-2020s that, it's probably close to 90% of those things that are centrally cleared. So I don't want to get into the semantics of, they ought to be, or they're definitely, or they're recommended. But just remember, a way majority of those things are centrally cleared. If they are non-standardized trades, then you've got to have higher initial margins. You got to have a scenario under which that variation margin is committed and paid, much quicker. Maybe some higher collateral requirements. And then you can't do this in the back room. It's got to be reported. So what have we been saying here? Transparency, risk reduction, supervised oversight. And, I'm going to editorialize here for just a second. I'm all in favor of regulatory supervision as long as it's efficient. I am not in favor of over supervisory regulation. That's just me, though. All right, so here's a little bit of a summary of what we've been talking about. Efficient regulation. So think about that. Efficient regulation would have a mitigating factor on systemic risk, increased transparency. Of course, this make more of an emphasis on central clearing rather than the by clearing. There's collateral and there's consistency. And this is what you guys who are watching here in the United States and maybe especially throughout the world, that one of the criticisms of Donald Trump as a president in both his first and second term was that we're not quite sure what he's going to do every day. And so we know that financial markets, including the derivative markets, they pretty much like to know the rules of the game. And so consistency is another one of these regulatory goals. So what happened after, that G20 got together? What are the consequences? What are the transformations? So, of course, CCPs become more important. These derivative contracts are way more standardized than they were in the 2000s. And members of the clearinghouse corporations or the CCPs, they've got to have stricter standards there. So look at the bottom. Yeah, improved stability, reduced contagion. There's that word I used earlier. But what that does do is that makes these CCPs more important. And so you always have to worry about, okay, if we make some organization more important, are they going to take advantage of that importance? All right, so yeah, these regulators now authorize, monitor, stress test. So now these CCPs, financial resources, like I couldn't open up my own CCP. Jim's CCP. What do I have? I have a bunch of straw over here, but I'm smart. I'm pretty smart, but that's not going to cut it, right? Sound risk management procedure. So this is so cool because what GARP is trying to emphasize here is that a lot of our focus has been on financial institutions like a bank. How does a bank manage the asset side and the liability side? And what about the capital requirements? Now, of course, lots of these financial institutions become CCPs. And so this is all part of their thing. Think about transparent governance structure. So we've got this big umbrella, and then we have all of these little things that are going on. Yeah, look at the bottom. There we go. Sources of systemic risk. All right, so what happens to the market? And this is why I emphasized to you earlier that I'm in favor of efficient regulation, because efficient regulation will then lead to, oh my gosh, when I was in graduate school, my PhD professors would use that term price discovery all the time. And that's, this. Remember 1970, Eugene Fama came up with this efficient markets hypothesis. And back then, all the people from Chicago were saying, prices are instantaneously reflected into market prices. And that sounded like a great idea. And I was all in favor of it. But then I thought over time, and going through the CFA program and going through the FRM program, I realized that, snapping your finger always doesn't work. So price discovery, market discipline is so important. So of course, we've got more standardization. We have more collateral requirements. We've got to worry more about capital. Supervision. And so look at the bottom. You're going to see this again. This has to be an exam question. We're more efficient. We're more transparent, which means that when we have this event, like the 2008 financial crisis, that we're going to be able to handle it. And of course, in the risk management world, that word is resilient. All right, difference between margin requirements in central clearing and bilateral clearing. Let's start with the central clearing. The initial margin, that's just the buffer. Now look there in that second point, must cover a 5-day price changes with 99% certainty. Now, although this chapter doesn't talk at all about value at risk or expected shortfall, this could be a potential link between this chapter and all of those other chapters. So we've got the initial margin and then the variation margin. That's just a requirement of hitting the margin call. Now, you remember that, of course, if you're on the futures exchanges, this is daily settlement. And in some of these markets, in the over-the-counter market, you can have intraday. I mean, you can have 10 o'clock and 12 o'clock and 1 o'clock. What that does is that you can get this margin call throughout the day, which then will reduce not just the overall systemic risk, but it reduces risk to all of the parties there. So there's the default fund. We did that before. Standardized rules. In the bilateral market, of course, we may or may not have an initial margin. I mean, if you go back 30 years or 40 years, these were negotiated, but nowadays there's almost always less common. I mean, historically less common, but nowadays it's common. I can't imagine this would be an exam question. 10-day price changes, here's 5-day price changes, but it's probably something to worry about. The variation, we're not going to do this in the over-the-counter market. We're not going to do it daily. We might do it weekly. We could do it bi-weekly. We could do it monthly, really. And it all depends on what the underlying asset is. There's no default fund, so that's probably an important part. There's no standardization. So this is where you get into, this kind of a disconnect where the chapter is emphasizing that in the over-the-counter market that you've got super ability to customize and tailor a contract. But we've just learned that there's lots and lots of standardization. So here's the idea that we need to make certain that we separate in the over-the-counter market the standardization stuff, which looks an awful lot like the exchanges, and then the non-standardization stuff, which is going to have probably completely different rules, which of course is in the bilateral market. If you have, and let me go back here. If you're in the central clearing, then you're going to have standardization, and that's going to look like these organized exchanges. Remember now, what did I say to you? Most of these OTC contracts are standardized, but some are not. Maybe 25%, maybe 30%. So you need to make sure you read the question stem and you process, all right, what market am I in? I'm in the over-the-counter market. Am I standardized or am I not? One link will be, a description of a bilateral market. Now, the next section in this chapter is a discussion on moral hazard and adverse selection, which we have talked about multiple times throughout the FRM program. So here's a question that tells us what's going on. Remember, adverse selection simply means that one trader knows more about the underlying asset than the other trader does. Moral hazard means that I'm going to behave differently because my risk is being spread out by somebody through someone else. Maybe it's government. So let's see. I love this potential exam question because when I was taking the exam, I was noted that GARP likes to ask a question, and they give you two types of questions in there. So here we need to figure out whether it's moral hazard or adverse selection, and then we need to figure out what the reason is. You see how you're limited to 100 questions, so it's not 100 topics. Here there's at least two topics inside of this question. All right, I'll shut up here. Let's do this. Global bank, two clients. Client A, highly rated, stable utility company. All right, so that's not Jim, right? So client A is the rock financial institution out there. All right, client B, speculative, highly leveraged, Jim's straw hedge fund, non-public, risky credit profile. Who knows about Jim? All right, so here we are. This global bank has the option to clear these trades bilaterally or to send them to a CCP. The bank's risk manager notes that routing client B's trade might be preferable, while keeping client A's trade bilateral would be more profitable. All right, so potentially this is a classic example of what do we like. So think about this. We're identifying that client A's trade with the bilateral, even though we just learned that, bilaterally this has a little bit more risk, but because it's, rock, what are we going to do? We're going to decide that, hey, this is probably going to be adverse selection, and we're probably going to say let's throw Jim's over into the CCP arena because they'll take care of it and we're going to be more profitable there. Let's go ahead and finish up a conversation on initial margining. So, of course, reduces counterparty risk. This marking to market is really part of the deal that dramatically increases liquidity in these over-the-counter markets. And the only way that you can have this increase in liquidity is, of course, if you have the variation margin and if you do this, in regularly settled periods. Loss absorption and contagion prevention. We talked about that. Systemic risk containment and liquidity discipline. So that relates to what I was saying back here about the marking to market and those margin requirements. Now, we had some good examples of netting back in the previous slide deck on the previous chapter. Skip down to that orange teardrop point. AO's B10, BO's A. Of course, the net exposure is 4. This was that example that I gave you before about my neighbors. You remember I owed neighbors over here and I owed neighbors over there. It takes me a long time to track them down. So that's a big problem with bilateral markets. Centrally cleared markets, on the other hand, all my neighbors, they just go to one place, and that's wherever that CCP is. Here's a good slide for you to take a picture of bilateral and centrally cleared markets. So there's scope, exposures, complexity, risk impact, and settlement. We probably mentioned lots of these things before. Take a picture of this and have it ready to study and memorize before the exam. All right, let's hit some of these last learning objectives. Impact of central clearing on the broader financial markets. This goes exactly to my reference to Eugene Fama and the efficient markets hypothesis from all the way back in 1970. How does this central clearing help financial markets? Remember, the role of financial markets is really pretty simple. It's just for capital to find its most efficient use. Mechanically then and operationally, that means that these CCPs, they provide a tremendous role, critical role, to reduce systemic risk, transparency, liquidity. We talked about that, netting, discipline, and market excess. Types of risk, we know about counterparty risks, liquidity risk, market risk, concentration risk. Remember, concentration is that it arises from the simple fact that the CCPs have become way more important. Model risk, I did that before. Margin risk requirements, legal risk. All right, how about the risks between and among the clearing members and the non-clearing members? All right, so this default fund contribution risk simply means, of course, that when a member defaults, then his or her friends, the surviving members. But what did I say earlier? We did a $100 transaction and we were supposed to put in a dime. You put in a dime, all of a sudden you've got lots and lots of money. So initial margins, that is that buffer, reduces liquidity risk. There's concentration risk. There's systemic risk again. But if we're a non-member, then we need to assess that risk. And remember, I've said this regularly inside of the last 30 or 40 minutes or so. This liquidity means that you can get in and out of these transactions and these trades, relatively quickly. But if it's non-standardized, if it's bilaterally cleared, finding someone to buy or sell the opposite position is, well, look what we write there. It's not always smooth, can't be guaranteed. There's this pass-through risk. They're indirectly exposed because of those CCP margin requirements, and then legal risk as well. How about one final potential exam question? So we've got clear, secure, billions of dollars in initial margin. So the question then is, what do you want to do with that? Under pressure, generate returns on this cash. So what can we do? If we're this clear, secure, we can buy some treasuries in the morning and sell them in the afternoon. Boy, if interest rates tick down just a little bit, maybe we'll make, well, if we have billions of dollars, clearly we should be able to make hundreds of thousands of dollars. But we're going to invest in a portfolio of 5-year corporate bonds. Oh, well, all right. So this makes a little bit sense. We want to get some extra return, but what do we have to give up? This just goes back to our economics days, marginal cost, marginal benefit. What are we getting? So we're going to get, pick a number of basis points. The 5-year corporate bonds, we're not told anything about their rating. I mean, these could be AAA rated. They could be C rated. So those are good potential exam questions here. But, what's happening here? Clearly, if we want to sell treasury bills, we're going to be able to do it like that, right? I mean, after all, there's $40 trillion worth of treasury securities out there. But corporate bonds, we know this from, at least part 1, maybe even in, book 1 and book 2, that corporate bonds have way less liquidity. So this is probably liquidity risk. So this potential exam question, what GARP could do is change a couple of these sentences in there, and each one of these could be the correct answer. And that takes us through. So this was fun for me. I hope you guys learned a bunch. There are 20 really easy questions at the end of this chapter. So as you're closing up, before you close down your mind, go ahead, look at those questions. I bet you can get through them in 5 minutes or so. So, hey, as always, I appreciate you watching and spending time with me, listening to my silly stories. They're all intended to help you trigger something so that you can answer a good question on the exam correctly. So, hey, have a great day and good luck studying.